Welcome to the 2026 Financial Mandate. 5 controversial moves to accelerate wealth. In this video, we will translate big financial goals into precise, time-bound actions. We will prioritize what actually moves the needle in 2026 and lay out a repeatable plan. Let's dive in. Here is the roadmap. First, we will tackle high-interest debt. Next, we will front-load tax-advantaged accounts. Then, we will build a strong emergency fund. After that, we will automate consistent investing. Finally, we will leverage income and assets. We will close with a smart setup and a 90-day action plan, plus 2 quick quizzes. This video is for educational purposes only and is not financial, legal, or tax advice. Contribution limits and rules can change, so verify 2026 figures with official IRS guidance and your employer plan documents. Consult a qualified fiduciary advisor or CPA before implementing strategies, refinancing, or altering asset allocations. Your risk tolerance, cash flow, credit profile, and tax situation are unique. Before anything else, set SMART goals. Make them specific with concrete dollar targets, such as $12,000 to credit card payoff by June 30th. Make them measurable by tracking weekly metrics like savings rate, change in debt balance, and net worth. Ensure they are achievable, calibrated to your income and obligations. Keep them relevant to your life stage and risk tolerance. Finally, make them time-bound with exact deadlines and a cadence for monthly reviews and quarterly reallocations. With that foundation, let us move into the first move. Start by focusing on high-interest consumer debt. Prioritize balances with annual percentage rates above 15%. Choose an execution method. The avalanche method targets the highest APR first and minimizes interest cost. The snowball method targets the smallest balance first and maximizes psychological momentum. Whichever you choose, automate payments and aim for debt-free status by mid-year so you can redirect that cash flow into investments. If your balances are overwhelming, explore consolidation or refinancing options, but always seek professional advice before using secured assets such as home equity. The goal is to convert dumb debt into immediate investment capital. This diagram will show you 2 branches. One branch implements the avalanche method, where the extra payment goes to the highest APR. The other branch implements the snowball method, where the extra payment goes to the smallest balance. In both cases, minimum payments continue on all other debts. The flow loops monthly until the debt-free milestone is reached by mid-year. The final node redirects the newly available cash flow toward investments. Use this as your monthly execution map. After debt, immediately front-load your tax shields. Increase your 401k contributions to capture the full employer match and aim to hit the annual limit by year-end. If cash flow permits, lump sum fund your Roth-IRA early to maximize time in the market. If you qualify for a health savings account, fully fund it and allow it to grow as a long-term asset by paying current medical costs from cash if advisable. The context suggests tentative numbers for 2026, including around $24,500 for a 401k, $7,500 for a Roth IRA, and $4,400 for an HSA. Always verify the final IRS limits and your plan rules. Here is a quick table of indicative contribution targets from the context. First, the 401k, at approximately $24,500 or more, front-loaded through your paycheck percentage, often with about a 6% employer match. Second, the Roth IRA, at $7,500, ideally lump-summed early in the year. Third, the HSA, at $4,400, funded automatically each month or lump-summed during open enrollment, with some employers seeding a small amount. Again, confirm final limits and your specific plan provisions. Now, transition to your emergency fund. Target 3 to 6 months of living expenses, with many savers choosing a dollar target, such as $25,000 or more held in a high-yield savings account. Direct raises, bonuses, and small weekly transfers toward this fund until you reach your goal. Give the account a distinct name and automate transfers every payday. Keep it segregated from your investment accounts to avoid tapping it and to protect your long-term compounding plan. This Gantt chart lays out the first half of 2026. The setup section covers calculating your 6-month expense baseline, opening a high-yield savings account, and automating transfers. The funding section runs weekly and monthly, directing 10 to 20% of net pay, plus any bonuses or refunds, and small weekly microsaves. Milestones are 3 months of expenses by the end of March and 6 months by the end of June. Treat these dates as non-negotiables. With protections in place, automate investing into diversified, low-cost index funds and ETFs. Aggressive savers target a savings rate of 35% or more of gross income. For short-term cash needs, consider a ladder of treasury bills for safety and predictable maturities, while keeping the majority invested in long-term index funds. The decision flow shows priority funding of tax-advantaged accounts before shifting to a taxable brokerage account. The long-term goal is optionality, building liquid assets that provide independence regardless of employment. Quiz time. Which action most reliably produces a guaranteed return in 2026? Option A, picking the hottest tech stocks. Option B, paying off high-interest consumer debt. Option C, timing the market with options. Option D, holding cash instead of investing. To go. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is paying off high-interest consumer debt. Eliminating a balance at 20% APR is equivalent to earning a risk-free 20% return. It is immediate, certain, and improves future cash flow that can be redirected toward investments. Here we compare two funding tactics. Front-loading maximizes time in the market and captures employer matching dollars sooner, but it requires a stronger cash buffer and exposes you to higher short-term volatility risk. Dollar cost averaging smooths entry, is easier on cash flow, and can reduce regret risk after market drops, but you may sacrifice some time in the market. Choose based on liquidity, temperament, and employer match mechanics. Finally, accelerate wealth by growing income and optimizing assets. Target raises or role changes such that income outpaces inflation by 5% or more, or pursue a higher household income goal such as $400,000 where appropriate. Monetize skills through consulting, courses, licensing, or productized services. Renovate properties where the increase in value is compelling, recognizing that a revaluation can help with insurance accuracy or future financing, but may increase property tax assessments. Focus on assets and projects that expand operating margin and produce non-W-2 income. This timeline lays out a sequence for income expansion. In the first quarter, benchmark compensation and negotiate or consider a job change. In the second quarter, launch a side product or consulting offer with an initial monthly recurring revenue goal. In the third quarter, make a renovation decision, obtain an appraisal, and adjust insurance coverage. In the fourth quarter, formalize or optimize your business entity, complete tax planning for non-W-2 income, and select the right retirement plan for self-employment if applicable. Here is a 90-day sprint. Weeks 1 and 2, audit your net worth, list every debt with balances and APRs, and set SMART targets. Weeks 3 and 4, automate minimum payments and send all extra to the highest APR account, and increase your 401k percentage to capture the full employer match. Weeks 5 and 6, open a high-yield savings account, start weekly transfers, and lump sum your Roth-IRA if cash flow allows. Weeks 7 and 8, create a treasury bill ladder for near-term needs and automate purchases of broad index funds. Weeks 9 through 12, optimize recurring expenses, negotiate lower rates, and scope or launch a side income initiative. Second quiz. What is the recommended emergency fund target for experienced savers in this plan? Option A, 1 month of expenses in checking. Option B, $5,000 in cash at home. Option C, 3 to 6 months of expenses in a high-yield savings account, often around $25,000 or more. Option D, no emergency fund and invest everything. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 3 to 6 months of expenses in a high-yield savings account, commonly $25,000 or more depending on your baseline. This buffer allows you to maintain aggressive investing even when unexpected costs arise, without interrupting retirement contributions. The key takeaways are simple. First, eliminate high-interest debt to free up cash flow. Second, front-load tax-advantaged accounts to capture the match and maximize time in the market. Third, build a strong emergency fund to protect the plan. Fourth, automate low-cost, diversified investing to maintain consistency. Fifth, leverage both income and assets to expand your margin and add non-W-2 streams. This pie chart illustrates one possible allocation for an aggressive saver. It dedicates 35% to tax-advantaged accounts, 25% to taxable investing, 15% to fixed expenses after optimization, 10% to the emergency fund until fully funded and then reallocated, 10% to short-term instruments like treasury bills, and 5% to discretionary spending. Adjust based on your reality and constraints. To conclude, define SMART goals with precise amounts and dates. Execute the 5 moves in sequence and automate as much as possible. Review monthly, rebalance quarterly, and verify the final 2026 contribution limits. Above all, precision and consistency beat market timing. You have a clear mandate for the year. Thanks for watching. If this helped, please like the video, share it with someone who needs a clear 2026 plan, and subscribe for more practical, no-fluff financial playbooks. Drop your questions and your own 2026 mandates in the comments so we can build better plans together.